In the last video, we talked about pricing strategies for consumers. Now we're going to talk about business-to-business pricing strategies. Just as a general note, it's going to be less psychologically and more financially and practically oriented than consumer pricing. And there's going to be lots of fine print to it. So if you get involved in this, you will need to read the contracts carefully. We're going to just do a general overview in this presentation. So again, business pricing strategies. This is geographic pricing, so it's location-based prices. FOB is a very common term in shipping, and there are many forms of FOB, and you really need to read the contracts carefully, especially the fine print. So this first one is called FOB, Free On Board Origin Pricing. The seller's price excludes delivery costs. The buyer pays for all transportation costs. So for example, $200 FOB origin Beijing, the buyer pays $200 for the product, all the fees, shippings, taxes, insurance, etc. All transport costs from Beijing, seller to the buyer is borne by the buyer. Buyer usually arranges for the shipping and has full responsibility for any loss or damage during the shipping. So if you're going to need insurance and you're the buyer is going to pay for that insurance. In short, the buyer takes on all responsibility from the seller's door onward. FOB destination pricing, again, there's many forms of this. You got to read the contract carefully or get someone involved who knows about contracts for shipping. Seller includes transportation costs in the product's final price and retains ownership and responsibility for the goods until they arrive at the buyer's location. So the product does not change ownership until it reaches the buyer. An example, 250 FOB destination Chicago means the buyer pays 250 total and the seller covers all shipping and delivery charges to the seller's place in Chicago. Oftentimes it'll say loading dock or something, buyer's loading dock or something like that, and list an address. Buyer may prefer this when the seller has economies of scale and logistics, preferred carrier rates, or they just want a simplified total experience in buying. Transfer pricing is another geographic pricing. Prices are charged in sales between an organization's units, usually across borders. So this is one company, it's got multiple divisions, it's selling product from, say, the main office to satellite offices. And this is actually very common in bigger corporations. So for example, a US-based XYZ company makes a product for $25,000. They sell it to their European XYZ office. The EU XYZ office then sells it to end customers in the EU for $100K. Now you may say, how do you set transfer prices between two companies? It doesn't really matter, does it? Because it's all one big entity. Well, no. Transfer prices are often manipulated to avoid taxes, and this can be very important. There are simple and extreme examples, and I'll give you one of each. The U.S. Actual corporation taxes is about 3% on profits. That's not the stated, that's the actual. EU corporate tax, I've heard the average nowadays is about 21%. XYZ wants to pay the least amount of tax. They want to keep the most amount of money for themselves. So option one, U.S. sells to XYZ Europe for $25,000. So then the EU branch sells it to their customer for $100,000. They get $75,000 profit, and the U.S. gets $0 profit. Okay, so the EU tax, it's 21%, as we said, times 75,000, 15,750 US dollars. U.S. tax is 3%, as we said back here, times $0, and that equals $0. Option two, the U.S. sells to XYZ Europe for $100,000. U.S. gets 75K in profit, EU gets 0 in profit. The EU tax, 21% still, times 0 equals 0. The U.S. tax is 3% times 75,000, 2,250. XYZ Corporation saves $15,750 minus $2,250, or a total of $13,500. So countries know about this thing, and depending on how you do it, it can be illegal or legal, and you have to be really careful because you can be nailed for tax evasion. Okay, discounting. So this is also familiar from consumer pricing, but there is also discounting in business-to-business pricing. And it's just a deduction from the price of an item. So we're all familiar with that. There's many types. One of these is called a trade discount, and it's a reduction from list price. And it's usually from a manufacturer or wholesaler to a buyer, retailer, or another wholesaler. And the discount is provided as compensation for the buyer doing some marketing functions. For example, warehousing, distribution, promotion, things that contribute to the product's movement from the manufacturer to the final consumer. And this is paraphrased from the AMA. An example, manufacturing sells Duckmark a widget for $10 and they're going to take off $2 if Duckmark takes an extra month's product and puts up in-store signs. So they're going to do some warehousing and they're going to do some advertising, and the seller is going to take off $2. In other words, they're going to pay them $2 to do this for them. Okay, next thing is quantity discounts. Well, this is easy. We've all seen this. You get higher percent off for buying more. Then there are cash discounts, and this is for either paying cash, for paying immediately, or paying early. A lot of companies take 30, 60, 90 days credit. If you pay cash immediately, you can oftentimes get a discount, and you can ask about that. Then there's seasonal discount, and that's buying when demand is low. And there are allowances. And this is when companies, the seller will give a middleman discounts for taking trade-ins. So cars, appliances, whatever, fridges. So yeah, General Motors, the dealers, the General Motors may give the dealer a discount for taking trade-ins of used cars. Okay, that is the end of marketing section 11. Let's go on to topic 12, which is product development, pricing objectives, and pricing methods, how to.